All right, let's take a look at what's happening in the markets so far this morning. Some softness in Toronto and New York as investors digest earnings, but also the latest on the economy. We got more evidence stateside that things are still running fairly hot, and that could push out expectations on interest rate cuts. Whereas in this country, we've seen evidence of a cooling economy, perhaps opening the door to interest rate cuts as soon as June. With all of this in focus, let's get some perspective now from Ryan Bushell. He's president and portfolio manager at Newhaven Asset Management. Ryan, good to see you.
Thanks, John. Good to see you as well.
So we're coming to the end of the month of April, and it's been a choppy month of trading, and one could argue it's this back and forth on what happens on the interest rate story in the U.S. that has been one of the biggest catalyst, but what's been your take on the mood of the markets recently?
I think it's interesting when you look at some of just the swings, the daily swings in some of these mega cap stocks. 10% moves in companies that big. I read an article the other day, just not the norm. So it speaks to some of this maybe speculation and or just froth in the market generally. What's been encouraging for us actually is the moves in utility stocks. Even with rates staying high, we've seen some strength come into those companies, and we think that that's a developing story that's something to watch over the next few years here.
What do you think is the catalyst for that happening?
It's a good question. I mean, I think we're due for a rotation. I'm like a broken clock talking about that, but it does seem that there is some appetite out there to maybe take some risk levels down. When you look at the GDP data that came out last week, the stagflationary kind of impulse of higher inflation with stagnant growth is not a good thing for markets. And so when you get into that type of environment, risk-taking tends to decrease and sort of a flight to safety occurs. And
then when we're talking about GDP in this country, obviously today we got evidence that while things aren't falling apart per se, things aren't exactly described as robust. And there is a growing expectation that we will start to actually see a change in interest rate policy soon.
Yeah, and the ECB as well. And also very interesting what's happening in Japan with the currency, right? So those three currencies are the three main offsets to the U.S. dollar. So they're all weakening and potentially set to weaken materially here, which again isn't going to help S&P 500 earnings going forward. If those global earnings again being translated back with a stronger U.S. dollar, that's a tougher story for earnings in the back half of the year.
So on the utilities beat specifically, which you pay a lot of attention to, and I think it's arguably the same question you could ask of someone who's looking at a fixed income portfolio, right? Mm-hmm. As long as this interest rate narrative is in the air, it could impact the day to day. But in terms of the timing and sort of moving towards that kind of sector, what would be the biggest points supporting doing so right now?
So we think it's two-pronged, really. So the first one would be we see secular or structural growth ahead. Just the growth in power demand that's coming. Everybody sort of sees EVs, but it's also public transport that's being electrified. Bigger things we see as reshoring of manufacturing activity. We've seen big announcements from Intel, Micron, Taiwan Semi on chip manufacturing in the U.S., but it's all types of manufacturing actually, and that's a major power usage demand growth area. And then data center growth, which is becoming more mainstream now as well. We've been talking about this for some time, but just the AI revolution, we've gone past the point where efficiency gains in semiconductor production are being offset by just capacity additions, and just the sheer capacity being added is taking power growth from a 0 to 1% CAGR, which we've seen over the past kind of couple of decades, to potentially 5+. So we like the structural growth, and then we think you're getting in ahead of that. On rates, we think that no matter what happens with rates, that work is still going to have to be done, that power demand growth is coming. Manufacturing construction spending has tripled in the past couple of years. That is power demand growth that is being built and will stay on stream. So that power demand for grid expansion and just different power generation sources is coming. And so regardless of what happens with rates, that happens. But if we do get an interest rate cycle here that comes downward because of weakening in the economy, interest rates staying high for too long and choking things off, that could be another catalyst. And we do see some softness maybe potentially post the U.S. election. So we're getting into 2025 by that point, but we're pretty patient, so not in a big hurry.
And maybe starts to get people looking at those yields on some of those names. It is interesting. Everything you're saying kind of points to a roadmap for the next decade, and yet this sector gets only a thumbnail's worth of attention versus, let's say, the AI boom boom or NVIDIA specifically, et cetera. Okay, against that backdrop, your top picks today would include a few names you've talked about in the past, but among them Aecon, TC Energy, Fortis. Any common themes that bring these ones together for you?
They're actually kind of three different areas amongst the same theme. So on Aecon, it's the construction side. So they have a big nuclear refurbishment business in Ontario. They won the contract for the Darlington, or were part of a consortium that won the contract for the small modular reactor that's going to be developed. We'll see how that goes. They also have a small transmission line business, but what they're doing in the United States alongside Oaktree Capital, looking for utility construction opportunities, we think is exciting as well. They've done that smartly, we think, in a JV structure. And so, you know, all the attention on the stock has been these 4 legacy contracts that were started in the last decade. We think the decade going forward is starting to look a lot better, and that's why you've seen, hopefully we've seen a good run up in the stock, and we think it continues.
And then, okay, so that was Aecon, TC Energy, which right now everybody's talking about the big push towards the Trans Mountain expansion and a bigger focus on the oil that's flowing through Canada and out of the country.
Yeah, so for TC, you know, post the spinoff of South Bow, which is supposed to happen this summer, and that's their liquids oil business, it will be almost a purely natural gas transmission company. They touch over a quarter of all natural gas molecules in North America and over a third of North American LNG feed gas molecules. So LNG growth, although there's been a moratorium placed on new development, there's still a lot of projects coming on stream in the next sort of 3 to 5 years in the United States, and one big one in Canada that could potentially be expanded. So we think the opportunity for TC Energy on the gas side, just given that it's going to be hard to build greenfield nuclear, renewables is showing to be not a scalable power source, that natural gas is going to fill the gap in a lot of spaces in North America and globally, and so we like TC for that reason.